Investor psychology, how fear butchers your profits. The emotional circus that runs your financial decisions.
Welcome to the wonderful world of investing psychology, also known as the never-ending circus, where your emotions set your money on fire while Wall Street laughs from the VIP section. Everyone loves to talk about strategy, discipline, and long-term thinking. But let us be honest, most investors are not logical masterminds. They are fragile humans wired with fear, greed, and a brain that panics at red lines on a chart like it is seeing the Grim Reaper. The result? Profits evaporate, portfolios implode, and the only thing that compounds faster than interest is regret. In this video, we are going to rip the mask off your emotions and expose how fear, greed, and panic secretly run your financial life. From the silent partner called fear that drains your profits to the art of panic selling that makes you Wall Street's favorite charity case, to the full-blown existential crises you invent during a minor market dip, nothing will be spared. Consider this less a finance lesson and more a roast of your emotional disasters. Sit tight, because this ride will sting. But it might just save you from donating your future yacht to someone else's brokerage account.
Fear, the silent partner who takes half your profits and pays no rent.
Fear is not just an emotion. In the stock market, fear is a full-time parasite. It sits on your shoulder, whispers in your ear, and convinces you that the world is ending every time the market drops by 0.5%. It does not matter if you have researched the fundamentals, analyzed the charts, or pretended you were Warren Buffett in front of the mirror. When fear takes the wheel, your portfolio does not drive toward long-term wealth. It drives straight into a ditch, and you are the one holding the shovel. Let us get brutally honest. Most investors lose money not because the market is cruel, but because they are cowards. Fear tells you to sell when prices are low and to stay out when opportunities are massive. Fear is the freeloading business partner that demands a majority share of your profits while never investing a single dollar. It makes you think you are protecting your capital when in reality, you are burning your future wealth with a smile. The human brain was designed for survival, not for stock markets. Cavemen did not worry about quarterly earnings reports. They worried about lions hiding in the bushes. Fast forward a few thousand years, your brain still cannot tell the difference between a tiger about to eat you and a red candlestick on a trading chart. Your heart races, your palms sweat, and you start imagining financial doom. Fear transforms you into your own worst enemy, sabotaging your strategy with panic-driven decisions. This is why the phrase emotional investing is basically a polite way of saying you are financially self-destructive. When you allow fear to dictate your trades, you are not an investor. You are just a gambler who panics at the first sign of losing chips. Fear is subtle. It does not always scream at you. Sometimes it whispers things that sound reasonable. Maybe wait until the market feels safer. You should sell now before things get worse. Do not risk too much. You might regret it. It sounds logical, right? Except that waiting until it feels safe usually means you buy at the top. Selling now before things get worse ensures you lock in losses instead of riding the recovery. And do not risk too much translates into keeping cash under the mattress, while inflation eats it alive like moths in a closet. The result? You do not just lose profits. You lose opportunities, confidence, and eventually your sanity. Fear makes sure that every dollar you could have earned gets donated to investors who had the audacity to stay calm while you were hyperventilating into a paper bag. Here is the cruel joke. Fear convinces you that by selling, by getting out, you are taking control. But you are not. You are surrendering control to your emotions, to that irrational part of your brain that believes red charts equal apocalypse. The illusion of control is the single most expensive lie in the financial world. If you want proof, look at every market crash in history. After every dip, after every panic, markets recover. But who actually benefits? Not the fearful sellers. It is the cold-blooded investors who ignored the noise, stayed invested, and laughed while the fearful donated their future gains. Let us break it down into numbers. Imagine you panic sell during a market dip and miss the 10 best days of recovery. Studies show that missing just 10 of the best trading days in a decade can cut your returns in half. Half. That is not just losing money. It is giving away years of financial growth, because your brain could not handle a little turbulence. Here's the emotional punch. While you are nursing your wounds and telling yourself, at least I did not lose more, the calm investor is sipping cocktails on the profits you handed over. Fear does not just cost money, it costs dignity. Fear is the most expensive roommate you will ever have. It pays no rent, eats your food, and still has the audacity to ruin your credit score. The moment you recognize it, the moment you stop letting fear dictate your financial choices, is the moment you finally become an investor instead of a puppet. So next time the market dips and fear starts screaming in your head, remember this: fear has no skin in the game. You do. The only question is whether you will keep letting it steal your profits or finally kick it out of your portfolio.
Why panic selling makes you the charity case of Wall Street.
There are many ways to lose money in the stock market. You can buy garbage companies, follow terrible advice, or confuse TikTok influencers with financial experts. Odd. But none of these compare to the king of self-sabotage: panic selling. If fear is the silent partner stealing your profits, panic selling is the full-blown financial robbery that you commit against yourself. It is the moment when you take your hard-earned money, wrap it in a nice gift box, and deliver it straight to Wall Street on a silver platter. When you panic sell, you are not protecting your capital. You are performing involuntary charity work for professional investors who thrive on your emotional breakdowns. You sell at rock-bottom prices because your lizard brain is screaming, the sky is falling. Meanwhile, calm investors and hedge funds scoop up your discounted shares, quietly thanking you for the generous donation. Congratulations, you just became the unofficial sponsor of someone else's yacht. And here's the cruel irony: panic selling always feels like safety. You tell yourself you are cutting losses or reducing risk. But what you are really doing is volunteering for the role of Wall Street's favorite ATM. You provide liquidity when the pros want it most, and in return, you get the sweet comfort of regret. Why does panic selling feel so irresistible? Because your brain loves instant relief. The market drops, your anxiety spikes, and the only way to shut up that internal voice screaming you are doomed is to sell. Selling provides a quick dopamine hit. For a few hours, you feel calm, but that calm is fake. It is the financial equivalent of taking painkillers for a broken leg without fixing the bone. And then what happens? The market bounces back, as it always does, and you realize you have sold low and locked in losses. Your portfolio is crippled, your ego is bruised, and the only thing you have left is the story of how you single-handedly funded the profits of smarter investors. Look at history. Every major market crashes. Years of 1987, 2000, 2008, and 2020 follows the same script. The masses panic sell. Prices crash harder. Fearless scoop up bargains. The market recovers. The fearful re-enter at the top. Rinse and repeat. It is a predictable cycle, and yet millions of investors keep falling for it. Why? Because panic selling is not about logic. It is about survival instincts misfiring in a modern setting. Your ancestors outran predators. You outrun imaginary financial predators in your brokerage account. The result is the same. You run until you collapse, and someone else eats better because of it. Let us talk numbers, because nothing stings more than cold, hard math. If you invested $10,000 in the S&P 500 20 years ago and never touched it, you would be sitting on roughly $65,000 today. But if you panic sold during one crash and missed just the 10 best days of recovery, your returns would shrink by nearly half. Half, that is the price tag of your emotional breakdown. Worse, panic selling compounds. Once you sell, you hesitate to re-enter. You wait for certainty. But markets never provide certainty, only volatility. So you stay out longer than you should, miss more growth, and end up permanently behind. You are not just losing profits, you are falling years behind your financial goals. Do you know how Wall Street views panic sellers? It's like free money falling from the sky. Institutions count on emotional retail investors to dump shares in moments of fear. They do not panic, they plan. While you are glued to your phone, refreshing red charts with sweaty palms, they are calmly buying at bargain prices, smiling at your emotional generosity. To them, you are not a competitor, or not even an investor. You are a donor. A permanent charity case who transfers wealth from your account to theirs in moments of crisis. Here is the harsh reality. The market does not reward cowards. panic selling is the ultimate act of financial surrender. You might think you are avoiding disaster, but in reality, you are volunteering to play the role of loser in the world's most predictable game. The next time fear grabs your throat and whispers, "Sell now, before it gets worse," remember this: panic selling is not saving you. It is saving Wall Street. You are not avoiding pain. You are scheduling it for later with interest. So ask yourself, do you want to keep being Wall Street's favorite charity project? Do you want to grow a spine and stop handing over your wealth every time the market sneezes? The choice is yours. Just know that every panic sell you make is another round of champagne for someone else's celebration.
Greed versus fear, the only cage match where you still end up broke.
If the stock market were a circus, greed and fear would be the two main clowns, and you, the investor, would be the gullible audience member who keeps paying for tickets even after getting robbed at the entrance. These two emotions are the ultimate tag team of financial destruction. One convinces you that you are about to be the next market genius. The other convinces you that you are about to be homeless. And between the two, your portfolio never stands a chance. Greed tells you, buy more. Everyone is making money, and you deserve it too. Fear whispers, sell now. Everyone is losing money, and you cannot afford to be the idiot left holding the bag. Back and forth, you swing between euphoria and terror, between dreams of Lamborghinis and nightmares of bankruptcy. The irony is both emotions are wrong, and both lead to the same result. You broke the market rich. Greed makes you buy at the top. Fear makes you sell at the bottom. And the professionals in the middle quietly pocket the difference. Greed is seductive, makes you believe you are smarter than the market, smarter than history, smarter than every crash that has ever wiped out overconfident investors. You see a stock climbing, and greed tells you this is your moment. Forget strategy, forget valuation, just jump in. That is why bubbles form. Not because companies suddenly become magical money machines, but because ordinary investors get drunk on greed. They throw cash at anything that moves upward, convinced the party will last forever. Spoiler, it never does. Greed builds castles in the air, fear demolishes them. Greed is the sweet talker, fear is the paranoid bodyguard who never shuts up. Fear convinces you that every dip is the start of the apocalypse. One red candle on the chart, and suddenly you are planning how to survive in a cardboard box. Fear does not care about logic, earnings, or economic cycles. It only cares about survival. It makes you sell perfectly good assets, because the thought of losing just a little more feels unbearable. And by the time you realize the market is recovering, the train has already left, and your seat was given away to someone braver. Here's the problem. When greed and fear fight, you do not win. You lose. Every single time. Why? Because you are not the referee of this fight. You are the punching bag. When greed wins, you overextend. You chase hot stocks, and you ignore risk. When fear wins, you cut your losses too early, miss rebounds, and sabotage your own future. And when they both win, which is most of the time, you end up buying high and selling low. The financial equivalent of running on a treadmill that spits out cash in the opposite direction. Most investors like to think they are rational. They believe they make decisions based on data, charts, and careful research. But the truth, greed and fear run the show, and your research is just a polite excuse for emotional impulses. You are not Warren Buffett, or a monkey pressing buttons in response to flashing lights. Want proof? Look at the trading volume during bubbles and crashes. It explodes, not because the fundamentals suddenly changed overnight, but because greed and fear hijacked the wheel. Investors love to call themselves disciplined, but their portfolios tell a different story. Wins when greed and fear play their endless cage match. Not you, not the average investor. The winners are the calm, disciplined, boring players who sit on the sidelines. Watch everyone else lose their minds and buy assets when they are cheap. They are not seduced by greed. They are not paralyzed by fear. They simply let the emotional circus unfold and collect the abandoned profits you left on the floor. While you are sweating bullets over red charts and green spikes, they are sipping coffee, smiling at how predictable you are. Greed versus fear is not a fight you can win. It is a show designed for your entertainment, and the ticket price is your wealth. You laugh, you cry, you panic, you cheer, and when the curtains close, your money is gone. The brutal truth is the only way to win is not to play their game. Recognize greed, acknowledge fear, and then ignore both. Build a strategy, stick to it, and stop letting your primitive brain hijack your financial future. Because as long as you let greed and fear battle inside your head, you are not the investor. You are just the casualty. And Wall Street loves nothing more than fresh casualties to feed the machine.
The emotional roller coaster that charges you interest on every drop.
Investing is often sold as a rational, numbers-driven process. Charts, ratios, models, it all looks so neat and professional. But for most investors, the reality looks less like a Wall Street PowerPoint and more like a carnival ride designed by a psychopath. You strap yourself in thinking you are in control, but once the market starts moving, you scream, you sweat, and you pray for mercy. Welcome to the emotional roller coaster of investing. The only ride where every drop costs you money, and every climb convinces you to throw more of it in. At first, the ride feels exciting. Your stocks are up, your portfolio graph is green, and you are already planning vacations you cannot afford yet. You tell yourself you are a genius, that this time you finally figured out the market. Greed climbs into the seat next to you and hands you a cocktail. Life is good. And then, out of nowhere, the drop comes. A bad earnings report, a tweet from some billionaire, or just pure randomness. Suddenly, the green numbers turn red. Your palms get sweaty, and you are screaming inside. What if it keeps falling? What if I lose everything? Welcome to the part of the roller coaster where the ride designer, also known as your brain, secretly charges you interest on every emotional panic. The roller coaster itself is not the problem. Markets rise and fall, that is normal. Problem is how you react to it. Every drop feels like disaster, so you sell at the bottom. Every climb feels like destiny, so you buy at the top. You are not riding the roller coaster. The roller coaster is riding you. And here's the kicker. Every panic-driven decision compounds. The losses do not just hurt once. They echo for years. Missing a recovery after a panic sell, chasing hype at inflated prices, sitting on the sidelines because you are waiting until things are safe, all of it adds up. The roller coaster keeps charging you interest, and the bill is always higher than you expect. You might think you are too smart for this. You read the books, you watched the YouTube gurus, you even memorized Warren Buffett quotes. But your brain does not care. Your brain was built to survive predators, not price charts. It interprets every dip as danger and every rise as opportunity, and it forces you into 5-4 flight mode inside your brokerage account. That is why the emotional roller coaster never feels optional. You cannot step off the ride because your own biology has you strapped in. Unless you recognize it, you are just another screaming passenger, clutching your phone while Wall Street quietly collects the money you threw away. Think of it this way. Every time you react emotionally to the market, you are paying hidden fees. Not to your broker, not to the government, to yourself, to your impatience, to your inability to sit still. Sell in a panic, you pay the fee of locking in losses. Buy in a frenzy, you pay the fee of overvaluation. Sit paralyzed while the market recovers. You pay the fee of missed opportunity. These are not small fees. They compound over decades, quietly draining your future wealth while you keep insisting you are being safe. Here is the cruel truth. The roller coaster was never designed for you to win. Markets thrive on emotional players. Volatility is amplified by panic sellers and greedy buyers. While you are screaming, institutional investors are calmly observing, waiting for you to dump your assets or overpay for theirs. To them, your fear and greed are just signals. You sell, they buy cheap. You buy in hysteria, they sell high. They are not on the roller coaster. They are the operators, charging you admission over and over again. The only way to stop being bled dry is to stop treating investing like a theme park. The market is not a roller coaster designed for your thrill. It is a long, boring, slow grind toward wealth. But only if you can stomach the ups and downs without screaming. That means discipline. That means strategy. That means ignoring the daily chaos and focusing on the long term. It is not glamorous. It does not feel exciting. But boring investors are rich investors, and emotional investors are broke. So the next time your portfolio dips and your stomach drops with it, remember, the ride only costs money if you panic. If you stay seated, ignore the noise, and let the ride play out, you eventually get off wealthier than when you got on. If not, you will keep paying interest on every drop until there is nothing left to charge. Because in this carnival of fear and greed, the emotional roller coaster is always open, always running, and always funded by investors who mistake thrills for strategy.
How your brain turns market dips into full-blown existential crises.
It always starts the same way. Little red line on the chart. A minor dip. A harmless correction. Rationally, markets go up and down, but rationality never had much say in your head. Within minutes, that small dip mutates into a Hollywood disaster movie playing in your imagination. Suddenly, you are not just down 3% on your portfolio. You are living in a cardboard box. Your kids are starving, and the only way to survive is to sell everything before the universe collapses. Congratulations! Your brain just turned a market dip into an existential crisis. The problem is not the market. The problem is the brain sitting inside your skull. It is a drama queen, cannot process normal fluctuations as normal. Instead, it sees every dip as a life-forwardless situation. You would think a creature that invented Wi-Fi and self-driving cars could handle a chart going down for a week. But no. Your brain is still wired for caves, predators, and immediate danger. So when stocks fall, your brain interprets it as threat to survival. Pumps cortisol into your bloodstream, makes your heart race, and convinces you that unless you act immediately, everything you own will vanish. Spoiler. Acting immediately is exactly how you torch your portfolio. One dip is never just a dip in your imagination. It cascades into catastrophic thinking. If it drops another 5%, I will lose half my savings. If I lose half my savings, I will never retire. If I never retire, I will work until I die. If I work until I die, I wasted my entire existence. And just like that, a temporary red candle on the chart has turned into a full-blown existential meltdown. You are not evaluating investments anymore. You are writing your own tragic biography in real time. Here's the part nobody likes to admit. Your meltdown is someone else's payday. The moment you sell in panic, someone else buys at a discount. They are not emotional. They are not panicking. They are calmly collecting assets. While you are busy spiraling into an existential crisis about working at Starbucks at age 72, the market loves your overreaction. It feeds on it. Without emotional investors like you, volatility would be lower and opportunities harder to find. But thanks to your brain's inability to chill, Wall Street feasts on discounted shares. While you write therapy notes about your financial trauma, part of the crisis comes from ego. You think you should have seen it coming? You think you should have sold earlier, bought later, been smarter, been more disciplined? Instead of accepting that dips are part of the game, you personalize them as evidence of your stupidity. This is where the existential spin kicks in. It's not just about money anymore. It is about your worth, your intelligence, your future. Your portfolio balance turns into a judgment on your entire identity, which of course is ridiculous. But your brain loves ridiculous. It thrives on it. Let us put numbers on the table. Missing just the 10 best recovery days in a decade can cut your returns in half. And when do those 10 days usually happen? Right after the biggest dips. The very dips that triggered your existential meltdown. So while you were panicking, pacing the living room, and doom-scrolling through financial Twitter, disciplined investors were sitting still, collecting the gains you donated. Your crisis did not just cost you money. It cost you years of progress. That is the hidden tax of emotional investing. You cannot stop market dips, but you can stop turning them into life crises. The trick is brutally simple. Detach. Remind yourself that dips are not the end. They are discounts. The red on the screen is not blood, it is opportunity. And when your brain starts screaming, "This is the end, you fool," remember that the market has survived wars, recessions, pandemics, and every dumb politician in history. Your little dip is not the apocalypse, it is Tuesday. Your brain is a terrible financial advisor. Left unchecked, it will exaggerate every dip, catastrophize every loss, and convince you to sell exactly when you should hold. If you keep listening, you will keep funding the portfolios of calmer, colder, less dramatic investors. So the next time a dip hits, ask yourself, do you really want to turn a minor blip into an existential crisis? Or do you want to silence the drama queen in your skull and finally invest like someone who has a clue? because the market will recover. It always does. The real question is whether you will still be in the game when it does, or if you will be busy writing your memoir. How I emotionally bankrupted myself.
Congratulations, you played yourself.
So here we are. After all the panic selling, the emotional roller coasters, the greed-fueled fantasies, and the full-blown existential breakdowns over a 3% dip, what do you have left? A bruised ego, a thinner wallet, and a Wall Street executive somewhere sending you a silent thank you note for sponsoring his third vacation home. You call it investing. They call it wealth transfer. Guess who is on which side of that equation? The uncomfortable truth is this: the market is not your enemy, your brain is. Until you learn to shut down the fear, silence the greed, and stop dramatizing every red candle like it is the end of civilization, you will keep playing the same game and you will keep losing. So the question is simple. Are you going to keep being Wall Street's emotional piñata? Or are you finally going to stop bleeding money for other people's entertainment? The choice is yours, but hurry, because the next dip is already loading.